Welcome back to The Explainer. Today, we're cracking open a really fascinating case. It's all about a company called Sable Offshore Corp. And the big question we're trying to answer is this thing a massive opportunity, or is it a ticking time bomb just waiting to go off? All right, so let's get right into it. The company in our crosshairs is Sable Offshore Corp. You'll see it called SOC. Now, on one hand, they're sitting on some really valuable assets, but on the other, they've got a mountain of problems. So what does the evidence actually tell us? Let's find out. Okay, first things first, let's set the scene. Who is Sable Offshore Corp? And what's this big promise that's got some investors so excited? So, SOC is basically an offshore oil and gas company. They own some pretty significant infrastructure right off the coast of California. A few platforms called Eureka, Ellen, and Ellie. But, and this is a huge but, production is completely stopped, halted. They're in what they call an asset rehabilitation phase. What that really means is that the company's entire value right now is purely theoretical. It's all based on the potential that one day they can get the oil flowing again. And that's really the heart of the matter, isn't it? This whole thing is an all-or-nothing bet. It's a binary outcome. It all hinges on getting that oil flowing again. Every single dollar, every single decision, it's all riding on that one single future event. All right, now let's put on our detective hats and look at the crime scene. Because there are some immediate, glaring red flags here that are basically screaming that this company is in deep trouble right now. Exhibit A, the stock price. I mean, just look at this chart. This stock has absolutely collapsed. It's gone from a high of over $4.50 all the way down near its yearly low. We're not talking about a minor dip here. This is a massive vote of no confidence from the market. Okay, next up, cash. How much money do they have left in the bank? Well, based on their last filing, they're sitting on about $5.2 million. Sounds like a lot, right? But here's the problem. They're burning through more than $1 million of that every single month. You do the math, that gives them about 4 months of runway, max. The clock is ticking, and you can hear it loud and clear. And if that wasn't bad enough, it gets worse. The company's total value, what we call its market cap, has dropped so low that they're now in danger of getting in trouble with the New York Stock Exchange. If they can't get that price back up, they could literally get delisted. That means they get kicked off the exchange. For a public company, that is an absolutely catastrophic blow. So you have to ask, what is going on here? What's causing all this chaos? Well, as they say, follow the money. Let's trace the financial trail and see if we can find the real culprit behind all this weakness. Now, when a stock drops like this, it's really easy to point fingers and blame short sellers, right? But the data just doesn't back that up. It's a total red herring. The real problem isn't some outside attack. It's coming from inside the house. It's fundamental. The company's generating zero, and I mean zero, revenue. It's burning through cash like crazy. And its working capital, the money it needs for just basic day-to-day operations, it's negative. They're in the red. So that begs the question, how on earth does a company with no income even survive? Well, it has to raise money somehow. And that very often leads to something called stock dilution. Let's just quickly break that down. Imagine the company is a pizza. Dilution is when they just create more slices out of thin air. The pizza doesn't get any bigger, so your slice just got smaller. And here's the thing. For SOC, dilution isn't just some vague risk on the horizon. It's pretty much a foregone conclusion. I mean, think about it. Their cash is critically low, they have zero revenue coming in, and they have these huge bills for repairs and regulatory stuff. They're backed into a corner, and they have very, very few other options to get the cash they so desperately need. In fact, the dossier we're looking at is pretty blunt about it. The analysis suggests there is an 85% probability that current shareholders are going to see their piece of the pie get smaller. And that's just within the next 6 months. 85%. That's huge. But okay, let's switch gears for a second, because this is where it gets really interesting. We're about to get to the smoking gun of this whole investigation. You see, all these problems we've been talking about, the cash burn, the falling stock price, the threat of dilution, all of it could just vanish. It could become totally irrelevant if one single thing happens. At the end of the day, it all comes down to this single quote. The dossier calls SOC a high-risk pre-production microcap. That's just a fancy way of saying it's a small, super volatile company that isn't making anything yet. And its valuation, its whole reason for existing, is entirely dependent on regulatory restart success. If they get that approval, We're talking survival and maybe a huge payday for investors. But if they fail, well, that's a whole other story. And believe me, getting that approval is not a walk in the park. It's more like running a gauntlet with 4 brutal stages. First, they've got to find more money. And yeah, that probably means that dilution we were just talking about. Then, they have to turn around and pour all that cash into super expensive repairs and pipeline tests. After that, they face this intense series of environmental inspections from both the state and the feds. And only if they pass all of that do they get to the final boss, the make or break regulatory decision. So where does that leave us? After digging through all of this, what are the possible outcomes? Well, the dossier lays out 3 very different futures for Sable Offshore. Let's break them down. First, you have the bull case. This is the happy ending. There's about a 20% chance of this. The restart gets approved, revenue starts flowing, and the stock could soar up to the $3 to $5 range. Then you have the base case. This is the most likely outcome with a 55% probability. This is basically just more of the same. More delays, more dilution, more debt problems, and the stock just kind of languishes where it is. And finally, you have the bear case. 25% chance of this one. The restart is flat out denied, and that would be a near total wipeout for shareholders. Look, let's be super clear. This is not investment advice. We're not telling you to buy or sell anything. The whole point of this explainer is to show you how to take apart a company like this, a really high-stakes situation. It's a case study in how you balance these massive potential rewards against equally massive and very, very real catastrophic risks. So at the end of the day, for a company like SOC that's really just hanging on by a thread, the story is always about the next chapter. And the question is, who gets to write it? Will it be the regulators who hold all the power? Will it be the financiers who decide whether to throw them a lifeline? Or will it be the management team that has to navigate this absolute minefield? That is the biggest question of all.